Welcome, everybody, to another episode of the Property Trio. Today's a very special one because we're talking market updates. And if you are plugged into a television or the internet, you will notice that interest rates have gone up. So that's an obviously big move that is going to have some implications. The data that we're looking at here is not necessarily pricing that in. So to help me disseminate the latest data, I've got my two lovely co-hosts, David Johnson and Cate Bakos, in order of how they appear on my screen. Thanks for coming, guys.
Good to see you, Mike.
Good to see you, Mike.
I was just sort of, putting some water on any favoritism in the way that I sort of announce people. But
you're right in the middle of my screen.
Is that right?
Yeah.
All right. So let's jump in to the meaty bits. The thing that we normally always start with is just a bit of an overall view of the capital cities versus the regions. And we're about to release an episode that we recorded a little while ago, but it's still going to be pertinent. And that was a special on the Perth property market. So please keep an eye out for that if you are invested in Perth or you're looking at being invested in Perth. The good news from the data, and I think the big standout for me, if you guys don't mind me kicking off, is that Perth is winning the race, up 1.6% in the month of October and 4.6% for the quarter, and again, leading the charge annually with a 10.8% increase. So Perth's a standout. What else have you guys discerned from the results?
Look, one of the things that is becoming clear is the middle-sized capital cities are the ones that are showing the strongest results at the moment. The markets are the strongest, and that lines up with the fact that their listings are below average. So what I'm talking about there is Perth, Brisbane and Adelaide. So as you've touched on, Mike, Perth is on fire and the first one to hit double figures in terms of growth over the last 12 months. And then we've got Brisbane not far behind in terms of the last month at 1.4% and Adelaide at 1.3%. So, yeah, there's real strength in those three capital cities and they've been the strongest over the last quarter. Whereas we're seeing listings jump in spring for Sydney and Melbourne and correlating with that, we're seeing a bit of a drop-off in the pace of growth, particularly in Sydney, which has come down below 1% for the first time in a while at 0.8. Melbourne's 0.5. Canberra's 0.1. Darwin's negative 0.1. And Hobart's had a strange run after all these negative months. It's jumped up to 0.8. So it'll be interesting to see whether that's turned around because they've still got a high level of listings down in Hobart.
Well, and we know that Miss Bakos has at least one property in Tasmania, so she'll be pleased to see that hitting the bottom. Do you think that's the case?
Oh, I think that we've always got data integrity as an issue when it comes to little markets like the Tasmanian cities, because you don't need very many listings and very much of a skew to really change the numbers. So, for example, if we had a few listings of, gorgeous riverfront properties, in some of the high cash flow areas, well, then you will see your median price change. So it jumps around a little more down there. The data's not as reliable and you really do need to be on the ground to monitor what's going on.
Yeah, and that's... Sorry, Dave.
I was just going to say, if anyone's reading the news, they'll be reading the stories about the Chinese multimillionaires and billionaires flying in on their private jets and being driven around on private buses and hoovering up properties in the 10 million plus bracket in Sydney and Melbourne. And there's possibly a bit of that going on in Hobart as well, which, as Cate alludes to, would impact its median growth rate, even though it's a hedonic index with core logics, a bit more complex than just medians, but I'm sure it'd still have an impact.
Yeah, and to your point, Dave, we've seen for the first time in a while an uptick of foreign investment, and we haven't seen that in the residential space for a long time. Yeah, well, I think it extends past just the Chinese, but we've certainly seen a change in that data because we had some real disincentives there for a bit with our tax changes, and I think that we're seeing a lot of people finding our market appealing.
The exchange rate helps, but just continuing falling lower. And I saw some numbers during the week, and yeah, the Chinese do outnumber, but there are a lot of other countries who are buying in Australia as well. And obviously, with the fragility of the Chinese economy, yeah, people are looking to get their money out and into safe havens. And I read also that that had been happening. I think it was in Singapore, but then they've really made it a lot more difficult for foreign buyers in Singapore. And I think Toronto actually might have even made it such that foreign buyers can't buy their residential property anymore. And there's a couple other capital cities who have gone to those extremes to stop foreign buyers picking up their property.
Mm. Yeah, I remember being on the ground when that sort of. I think the legislation must have come out in sort of the mid 2000s, where you could buy residency essentially if you were investing in a business or buying real estate. And I think the cap, Kate, you probably know better than me, was $2 million. And I met a few Chinese people buying very expensive apartments for their children to come and live in while they went to Sydney Uni. And these are the sorts of people that, if you Googled their name, you would get some interesting results, like heads of hedge funds and all sorts of different things. I remember seeing on the news the other day there were protests about saving these special visas. So obviously it's a great pathway for foreign investors to come into Australia and stay if you've got the money.
Yeah, it'd be interesting to look closer into that. From memory, it was $5 million, and it was the 888 visa. Is that right, Dave?
Oh, look, I wish I knew more. We actually are looking, chatting with an immigration lawyer and looking at bringing some of our offshore staff over at the moment for the first time to sponsor them. So I'm getting more expertise in that area.
Yeah.
But, Sarah has me covered by a fair way. But I think it sort of interconnects with our record migration numbers. So we've had 500,000 new entrants to Australia over the last 12 months, which is a record by a long way.
Record for all of the years. We've never had a year like this.
Yeah, which also plays into the inflation story because that's bringing more money, pushing up inflation, obviously keeping pressure on jobs, and also there's going to be more people who come from wealthy families whose families are trying to purchase property in Australia. That is also putting pressure on property prices. So there's all these things sort of interconnect, don't they?
Well, they do, and we've got our inflation issue isn't so much goods at the moment, it's services. We actually need more people to fill that gap because our lack of service providers is pushing up prices. It's a simple supply and demand concern there. But yeah, it's creating lots of other unintended consequences, isn't it? Because we don't have enough building starts and we're getting all of these new arrivals who are either needing to buy or needing to rent. Either way, they need housing.
We don't have enough housing, but that we don't have enough people to fill the roles to keep inflation down. So when we get them in, that makes the housing problem worse.
Yeah. But skilled migration,
unemployment is so low, so businesses have greater overheads with salary pressures, and then the transition to green energy is pushing up electricity prices, which is ongoing, which households feel, but what a lot of people don't think about is businesses feel as well. So again, pushes up prices. So all feeds into services prices, inflation becoming staying stickier.
And Kate, you were right about that 888. It's called the 888 subclass visa. So full marks for you. Now, Dave, you said before that it's the middle-sized markets that were doing well, or the middle-sized cities. Yeah. Do you think it's a size thing, or is it an affordability thing? Do you think that's really what's driving those markets, is that they are somewhat cheap compared to places like Sydney and Melbourne?
Yeah, well, they're more affordable because there's not as many people living in those cities. So yeah, it's absolutely the affordability factor is a key reason. And if you watch the history of the medians of the capital cities, when they become relatively more affordable, you do tend to see a flow of buyers into that area, into that city, into that region, And I think that's definitely part of what's playing out. It's interesting, though, that correlation of listings and why we're seeing, I guess, people are feeling more pressure in Melbourne and Sydney because of the higher prices from the rate rises. And so we're seeing the listings bump up. But yeah, it's interesting. Is why are we not seeing as many listings in Brisbane, Adelaide, and Perth?
Now, I want to keep our powder dry on the listing stuff because I know you've got some really good things to share there, Dave, especially with Perth. Now, Cate, you've written quite a number of blogs about the tree changes and the sea changes. I always enjoy reading your insights on those, and makes
I
me
wonder
want
who
to.
reads them.
Yeah, I just
get up early every Sunday.
Yeah, I just click on it just to
so I can
times,
see the stats
just to make you feel good. But so I want to ask you about the little worm that's telling us the rolling 3-month change in dwelling values on the combined capitals versus the combined regions. The regions are snaking back a little bit after what looked like a little bit of a downturn. So where are we at? Do we hate the cities and we want to move away because it's too COVIDy, or we can't swing a cat, or other awful metaphors, or are we still in love with the regions?
We are still in love with them. The problem that we have, and I've said this on the show many times, if 10,000 people leave Melbourne and land in Ballarat, then Ballarat really feels it, but Melbourne doesn't feel very much because it's a really small percentage for Melbourne and a huge percentage for Ballarat. And the same can be said when people are leaving a city. So we had a lot of people that did do tree change, sea change. Some have loved it and stayed on, and others have gone, you know what, this isn't working for me now. I love Melbourne again, I'm coming back, or I'm going to Brisbane or whatever. So we did see a lot of sales after the rush away from the cities. And for a little bit there, the regions felt like, there was a lot of low-hanging, really good fruit. I could go to the regions and pick up nice stuff. It's got competitive again. Not crazy competitive, but the people that are staying love it. And the sales that were initiated after people changed their mind, pretty much most of them have happened. What we see now in the regions when we cross-section the sale properties is some of them are investments. So we are seeing investors who are either feeling the pinch or investors who are feeling frustrated with the changed rental laws and the increased taxes. They're moving. So not every investor, but the total number of people who are moving away from the regions has slowed down, and I'm finding it reasonably competitive again.
Just on that legislation stuff, and we've probably bashed on this a fair bit, but the legislation changes around land tax in Victoria, they weren't grandfathered, right? So people are making long-term decisions based on a playing field with rules that they think they understand, and then they get changed.
Yeah.
Do you anticipate that there will be a little bit of a sell-off, or at least a real lack of participation in the state from an investor point of view because of those changes?
This is a good question, and I delved into the data a couple of weeks ago in a blog of mine, and we are seeing the highest number of investors as a percentage of total sellers leaving the market at the moment in Victoria. We have absolutely taken out the gong for a record number. And when we cross-section it and look closely at Melbourne, we've got a reasonably high percentage at the moment. But other cities are feeling it as well. Sydney is too, and that's a case study on affordability. So we've got investors leaving, but who's replacing those investors? There's a few. We've got first home buyers who are lower in number now than what they were previously. So they're not completely filling that gap at all. We've also got new investors coming in, and Dave can talk to the data. We've seen an uptick in investor lending because the credit policy is allowing it more now than it has been in past years. Yep. And the last contingent that are soaking up investor sales are actually second home people. So people who have the tree change, sea change house, and they're saying, you know what, I'd like my pad in the city. And they're soaking up that stock. And a lot of that evidence is anecdotal. You've got to talk to the agents and see who your competition is. But the inner city properties that I've been buying haven't been for people that are buying their only home or their first home. They've been for people that are buying an extra home. And the people that I'm fighting against and being outbid by, they're also getting second homes.
For policymakers that are trying to solve affordability, I mean, there's always been this idea that an investor sells, then a first home buyer buys, and then everything's right with the world.
Perfect utopian model, isn't it?
Yeah, but the people that are buying a second dwelling, I mean, the government would be able to see that they're not claiming deductions on it if it's not a rental property. I mean, should they be looking
now.
at? Yeah, right. I was going to say, should they be looking at disincentivizing that?
Well, here's the thing: if you stay in it, if you stay in it every second weekend and then you Airbnb it fully furnished, well, then you can partially claim deductions.
Yeah.
And even if you don't really offer it up very often, you've still got something there to deduct. And I'm not saying that everyone I've worked with has done that. In fact, most haven't. They've just furnished it and used it for themselves, and they've just, decided that it's a sunk cost that lets them have the lifestyle that they want. But if we then look at their ages, we're not talking about young people. We're talking about 40s and 50s and 60s.
They need to have it either tenanted out or lived in for more than 6 months. But if it's less than 6 months of the year, then there's a tax on those properties. So that was one of the ones they brought in with the extended land tax.
The tricky thing to prove is was it available for rent, but they just didn't get a tenant because they priced it such, or was it genuinely available versus strategically we've got to put it up, but we really would rather people not be in there. That's a difficult one to prove. Let's move on because we've got a bit to cover. Let's talk about rents. It doesn't look like there's any sort of.
It's not abating, is it?
No, there's no respite in store. I mean, we did see a downturn in Hobart and Canberra, but then the worm seems to be turning on those ones as well. But we're still talking about ridiculously low vacancy rates. I'm just
Record
fumbling
lows.
with the data here.
They are,
yeah.
Very low.
Lowest
so we're
ever.
talking 1.2% in the combined regions and 0.9% in the combined capitals.
Yeah.
Yet it doesn't seem like there's any stimulus or any change in the market that's going to point to a change in that direction. My personal view is that household makeups will change because rents just can't go to $10,000 a week for the average person because people just can't afford that. So there'll be more people deciding to share with somebody else. People will be living with their parents. There'll be much more sort of perhaps community housing style stuff happening.
A couple more as well, Mike. We saw COVID lockdowns exacerbated a lot of breakups.
Mm-hmm.
And we saw the household formation rate decline rapidly following COVID, and I think we'll see that return to normal levels. And that will consist of house sharers banding back together and house sharing, people moving back with parents, and also singles hooking up.
Yeah, right. Oh, good luck to them.
Yeah.
And so,
do you know something that might actually, which would be really hard to measure, playing into making that household formations rate more difficult, is the working from home phenomenon, because people need their extra space. So they might be less willing to share or have less space to share because they need a space to be able to work from home.
Yeah, absolutely correct. Yeah, the spare room's gone. The option of having a house sharer when you had a spare room is gone.
And I think the best evidence of that, Dave, is that we saw WeWork, the co-working business, which is a global juggernaut, has gone into liquidation.
Yeah, it was made on a house of cards. Business model, but yeah.
Yeah, they've got billions of dollars of outstanding debts. They've got billions of dollars of ongoing leases, and the revenues in the millions. So that's a real indicator that model is not as attractive as it was. And I think COVID, the regional shift, and the working from home has been the death knell for WeWork.
Yeah, and that's playing. That's like part of the big picture story of the slow-moving train wreck, which is the commercial property market, particularly offices and particularly CBDs. That's playing out and still has some time to play out further.
Yeah.
I think, like I was reading in the last week or two, the real estate investment trusts valuations in terms of the share price at like a 20 to 40% below what the companies value their own properties assets, net tangible assets at. So
That's
who's
interesting.
right?
Yeah. Yeah. But the ones that are more resilient are the industrial and certainly the self-storage, because we've all got too much stuff, haven't we?
Yeah. There's money in owning property to store your excess stuff.
Yeah.
True.
Yeah, and that's another thing that's feeding into inflation, isn't it? We are still buying stuff, we are still consuming, and I wonder if that factored into the RBA's decision in the lead up to, the
Definitely.
retail spending season, which is Christmas.
And what's the big sales day in November? Like I don't know.
There's the Black Friday.
Yeah, Black Friday.
Black Friday. Yeah.
Yeah. When is Black Friday? I needed you
I always thought
telling.
it was about now, to be honest.
Is it right?
When, for all our listeners are going, when is Black Friday?
The time to
soon.
Your
Kate Google's that.
Yeah.
National rental listings are 35.5% below the 5-year average.
Yeah.
That's
24th of November. It's coming up.
24th of November. Yeah.
Okay, so Kate, the time to buy a toy index is going to go through the roof.
I personally think that's one reason why the RBA were like, do we smash everyone's Christmas and do a December rate increase, or do we just get it out of the way in November?
Definitely. And then they can let the powder dry until February and see what the data shows.
Drop it by 2%.
So 1 in 3 properties on average that were listed as rentals are not available at the moment. There's only 2 in 3 available relative to the 5-year average.
And where's the vacancy rate stemming from? The available rentals or the actual rentals?
It would.
It's a bit scary, isn't it?
Yeah, I mean,
does that mean our vacancy rate is 2/3 of what we're reading?
No, I think there's just a lot less property on the market, which is what keeps the vacancy rate so low.
Yeah.
It's amazing, isn't it? 16% lower than a year ago, but 35%. Like that. That's a big. That's the problem. Is new stock.
Yeah.
So true.
And it doesn't look like it's going to change anytime soon. What is changing a little bit, but in a way that is kind of moot, is listings. Right?
Yeah.
We're seeing a big uptick, Kate, but it's getting swallowed up or hoovered up. I think I said a couple of weeks ago,
I've already said hoovered up once.
Hoovered up, yeah. Potential sponsor for the show. Reach out.
Do you know, there's a couple of cities that are doing a lot of heavy lifting with the supply of new listings, and that is completely reflected in their capital growth. Dave, you said this off air, and it's like a great insight. It's perfect supply and demand outcome. Melbourne, if we have a look at a year ago, we have 20.6% more listings than what we did this time last year. We've got a fraction more than what we did in September, but what it looks like for the big auction capitals is that we've had a pretty steady stream for our dedicated spring season. It doesn't look like everyone's got upset and decided to sell in October or November. It looks like people have made dedicated decisions to sell in spring, and we had, busy September, busy October, and we're having a busy November. And this is the first time in 3 years that I've had a traditional spring market to enjoy. Because if you cast your minds back to last year, we had more volume in winter than what we did in spring. It was a very odd season.
Yeah, it's certainly becoming a buyer's market in those locations, isn't it? Because
just for a moment, but it's also a very it's a multi-speed market. It depends on what you're looking at as well.
Yeah, and there are markets within markets, and depends whereabouts, type of property you're looking at, in which location.
Right. Yeah.
Dave, we've referenced your data twice, so people are just, they're going to start throwing beer bottles at us.
To hear about Perth.
Yeah. So what have you gleaned?
Yeah, I gleaned from reading
CoreLogic.
It's a very good word. From reading CoreLogic's information that Perth listings are almost 45% below the 5-year average, while sales activity is 25% above average.
Okay, there's no stock and whatever's there is going way faster than it ever has.
Yeah. There's for every 100 people, there's another 25 more than normal trying to buy, and
Is
almost
there?
half as few stock.
I know.
That's going to squeeze up prices.
Well, I think we've cracked that case already. We've seen the prices going up quite some time, and we've referenced our Perth episode, which is coming up. Check wherever you get your
Local
podcasts,
guides.
and hopefully you're a subscriber. Yes, please subscribe and jump on YouTube as well, because you'll get to see our lovely faces. Well, Dave and Cate's and my face, such as it is. It's
love a 5-star review too.
Yeah, 5-star review. Good. Yeah, look, we're a professional operation
all
now.
over it.
Yeah.
Right, back to listings.
Back to listings. Yeah. So with Perth, it begs the question: is there a little bit of a confirmation bias now, where people are looking at the prices and they're diving in, and it's actually kind of that fevered approach to it that's driving the prices from here on in, or are the value fundamentals there? That kind of is a worrying question.
It is fever that drives prices when you have a run. I mean, it's completely driven by sentiment right now. We've got all of these Eastern Seaboard investors going, yeah, let's jump onto the Perth bandwagon. And of course, that'll push up prices. It's a bit like watching a Bitcoin chart rise. If enough people are jumping on a good thing, and I'm not suggesting Perth is Bitcoin, by the way. I love Perth. But there is a frenzy right now, and if you ask the advocates over there, they'll all tell you that. There are lots of Eastern Seaboard investors who are getting excited, and there's probably a fair degree of speculation, not just well thought out strategy. There are a lot of people that do think it out well, and they're making sure that they're diversifying their portfolio and they're looking at Perth for all the right fundamentals. But for anyone who thinks it's a get rich quick, I've got some concerns about that.
Yeah. And some of those are coming up in that episode we talked about.
Yeah.
Dave, for people that realise, okay, well, a market is now having a flood of listings, what do they need to know about that influence on property prices? Does extra listings mean buyer's opportunity, or does it depend on how quickly those listings are taken up, and they should look at the days on market stats to get a true picture?
Look, I mean, it does mean there's more opportunities for buyers, and it does tend to reflect in the capital growth rates of that city that they'll start to slow down. So we're seeing that in Sydney and Melbourne. I think, we're starting to see a plateau. It'll be interesting to see if these numbers in terms of higher listings are an ongoing feature into next year, which is sort of what we've seen play out already in Hobart, Canberra, and I think Darwin. So, yeah, look, it's an opportunity to buy, absolutely. And then the question is, how long is that? We've just had another rate rise. What's that going to do to the market? Is it the last rate rise? At what point might we see rates come down, because prices will start to move again in locations once that occurs. So again, these are the short to mid-term decision making, and at the end of the day, we advocate long-term decision making. And if the time is right for you to buy and it's affordable, then you shouldn't get too caught up in these gyrations. And ultimately, you should be picking the property type and city that is right for you and your portfolio.
It's very sensible advice,
It is.
Dave. That's why people listen to the show, isn't it? Cate, we know that people don't want to sell for less than what they purchase, and loss aversion is a very dominant psychological force. Do you think that the markets need to show a bit of appreciation before they unleash the listings, i.e. people are going to want to sell in a rising tide, and that's kind of what we're seeing a little bit in Perth, that there might have been some pent-up demand, but I don't want to sell until, the market is hot?
Yes, and holding costs and gross rental yields will help you do that. When you're in a city that's giving you a better rental return than somewhere miserable like Melbourne and Sydney, you do have a few more choices, because for a lot of investors, or a lot of property owners in Perth, they've been close to set and forget, particularly while interest rates were low. So you can hold when your cash flows aren't biting.
Yeah.
I think it's a really good point, Mike, the loss aversion. There's going to be a lot of property owners in Perth who haven't seen have seen their property values go backwards or sidewards at best for a decade, and they're holding on, to get a return. And so that'll be interesting to see play out. We've obviously, the Perth market is now at a new high, but that doesn't mean everyone's at a high in terms of their individual property holdings. So that'll be playing a part in the Perth market, the loss aversion and wanting to make sure they've got a return on their property before they put it on the market.
But let's talk about the flip side of loss aversion, and it's distressed listings.
Yes.
Someone that's saying, I'm freaking out, no matter what I can get, I have to sell. That's a distressed listing. If we look at those numbers, what has really surprised me is total number of distressed listings in October 2023. The highest state is Queensland.
100%. It's
followed by New
isn't
South and then WA. So I'm looking at ACT and Tassie. They're like 27, 97. WA is 1,048. So to our knowledge, that's how many households are freaking out about having to sell a listing. Queensland is at 1,904. Now, that's been our boom state. What does it say about...
What does it say? I was thinking about this exact same thing this morning, reading those numbers. I think it means there's more high risk-taking investment in Queensland, and often probably from interstate buyers who are getting trapped into bad investments, probably lots of off the plans in there, and then they're distressed selling them. But when we can easily work it out, the percentage of distressed listings to total listings, because if we look at, say, total property listings, Melbourne's the highest at 38,000, and Victoria in total only has 860 distressed listings, and obviously this is capital city versus state. Brisbane has less than half total listings of Melbourne, yet total distressed listings of Queensland, you assume a lot of them will be in Brisbane, is 2.5 times more than Victoria. So there's a big disparity there, isn't there, in terms of the percentage in Queensland?
And I look 2.3% for Victoria.
Yeah, there's a lot of cries of how badly Victoria's doing, and I get it. A lot of investors are upset, but distressed listings is a really good measure for just how dire things are, and Vic's not up there.
And I'm glad you mentioned this topic, Cate, because it's exactly where my brain was at, because we've seen a couple of media stories about the mortgage cliff. We did an episode where we talked about the potential mortgage cliff, and I think our summary was that it is a little bit of a media beat up, and it's nowhere near what would be considered a problem. And if you look at distressed listings in October 2022, they're actually higher than October 2023. So
about 20%.
Yeah. So we've still got a lot of movement before we would actually think that there is a real distress in the market, right?
Yeah, fair to say.
Yeah, 100%. Yeah. But it is an interesting one, isn't it? The Brisbane property market is strong, and yet distressed listings in Queensland are the most by a significant percentage.
Yeah. Now, the consumer sentiment data hasn't been updated, so we're going to sort of skirt past that. And before I jump onto the gold nuggets from you guys, I want to talk about lending. Now, both sort of mortgage brokers, but I suppose Dave has the flag as the most
totally not a mortgage broker.
Well, I'm not a
past life anymore. Dave, talk to us about lending.
So total housing lending fell 7.8% in September, but it's still 1.5% higher than a year ago. But so we are seeing it fall back to the levels it was at around a year ago. So this is for refinancing. So owner-occupier and investors fell. Owner-occupier refinancing fell by about 8.4%. So those mortgage wars that you might have read about, with the providing lots of cashbacks for refinancing, most of the banks have stopped doing that now. But with the level of financing dropping, I pricing is starting to come back. You can get some pretty good pricing out there. They're really, in terms of discounts, off the standard variable rate. And I think with seeing these numbers fall, if the number of purchases don't start to increase, the banks are going to have to get their money from somewhere. And I think you're going to start to see more competition again in refinances.
Mm. And with interest rates such as they are, that's going to, again, soften the demand. Do you see any changes in the affordability metrics that APRA are kind of the custodians of? Do we think that the serviceability buffer is going to tweak if we see lending falling off a cliff because people are just really sick of the interest rates?
Look, there's been a lot of talk on hope, and I think it's been more hopeful than anything else, that APRA would bring down the buffer to make it more affordable for borrowers. And APRA put some statement out, I think in the last month or so, basically saying they weren't going to be doing that in the short term at least. So I think, they need to be very confident that the rates were at their peak. I almost think they wouldn't do that until rates were starting to come down. And then they go, okay, well, rates are heading that direction. Then they might consider dropping the buffer from 3% above the rate you're paying to maybe 2.5% or something like that.
Yeah. Well, that's sad news. Cate, before the gold nuggets, is there any good news? Is there good news for investors? It doesn't seem like there's good news for renters, but what can we expect in the next little while?
There is an uptick of investment activity. Dave will share that over the last couple of years. We've seen them come back, and obviously we've got higher returns. We've got tight vacancy rates, higher rental yields. There's talk about how potentially we could have investors stay in the market, or how we could incentivise investment activity when the penny finally drops. And I've seen a couple of clever papers on LinkedIn. I saw Stuart Weems put something out that was very thought-provoking, and that was around CGT and also limiting the buffering for investors. So whether that starts to gain traction or not, I don't know. I think we're a way away from any of our policy writers deciding to help investors stay active in the market. I don't think the penny's dropped yet. What I did note, though, first home buyer participation, I've circled a couple of stats there.
It'd gone up a little bit in terms of financing.
Just
home
slightly
buyers.
Recently, because they were down for the year, but only slightly. They've actually held reasonably firm. Employment stats, we've had a slight contraction there with employed.
But I think some of the underlying numbers were that the number of sort of the devil's in the detail, even though unemployment slightly dropped, people were working less hours and less people were searching for jobs.
Yeah.
So we might be just on the cusp. And actually, I was speaking to a guy who is the owner of a hiring business for high-end executives, and he said they've really their business has really just dried up in the last month or so in terms of companies hiring. Said they've had it really good for a really long time. So that's the sort of thing for me that is an early signal that things are about to start turning in terms of the employment space.
Maybe. There's a little bit of cyclic nature to that too, though. I know that finding professional work towards the end of the year can be a bit more challenging. Because and depending on what
he didn't say this was cyclical, like this doesn't happen at this stage each year. It's
right.
Let's go to gold nuggets from you two on the market update for today. I'm going to start with who looks the most prepared. These are the insights you get on YouTube. Now, Dave's looked away, so I'm going to take a point off him for that. So we'll go with Cate.
Now it's time for us to go mining for our gold nugget property tip of the day.
Yeah, my gold nugget relates to new listing activity for the remainder of the year. And obviously I'll talk about my market, but a lot of markets do slow down for Christmas break, and it's your coastal markets that have a great time in early January, and the rest of the cities are pretty quiet. So for anyone who's thinking that 2022 still has a few exciting listings to come out. You're probably right. I think we've got another 2 weeks of listing activity, and then we'll see the typical auction campaigns hitting in early December, and there'll be a shorter campaign of just 3 weeks. We'll wrap it all up with a big bow just before Christmas, and then that will be it. That's all, folks, for 2022. It will just be the leftover stock that hangs in January, and we'll crank things back up after Australia Day for a February start.
Yeah. It's obviously been a hectic year for you, Cate, because you keep talking about it being 2022.
Sorry, 2023.
You need a little bit of downtime.
Well, that's what happened to Melbourne, like the days and the months, they all just drifted. I do need a holiday.
You do need a holiday. Dave, what about you?
I think it is it's good buying time in Melbourne and Sydney with rising stock levels. I think that's going to continue. And I think, we're going to see the values certainly in Melbourne and Sydney continue to plateau. It's going to be interesting to see what happens in those middle capital cities that are quite strong at the moment. But, Melbourne and Sydney, I think, if you're considering buying, it's a good time. And I think that'll flow over into the new year as well.
Yeah. Be interesting to see what happens, and anecdotally, I'm hearing from certain people that cash flow is much more of a consideration. The high yields are great when interest rates are 2% and 3%, but we're now sort of struggling for people that want an aggressive LVR to have a neutrally or positively geared property, which is a bit of a shock to people in the feasibility stage. But time will tell. But we'll be here, as always, to navigate you through the changes, and we look forward to chatting to you next week. Thanks, guys.
Good to see
you
you
next week, everyone.